So good morning. My name is Scott Forcino. I'm an associate broker with eXp Realty. I founded PlugIntro so real estate agents and their colleagues gain more and better referral partners. I have with us today a member of PlugIntro, a host of his own local business development platform, which offers agents and local business owners a chance to promote their business, Jason Ramirez, and who's been an astute loan officer, lending industry observer, and a pro. So good morning, Jason.
Morning, Scott.
We're talking today on November 4th, just before elections, and market has shifted, and we are here kind of fast approaching holiday season. So I want to get your take on where we are and what can be done, and what do you foresee?
Well, thanks for having me once again. It's been quite a ride this year, especially with these recent rate hikes. The Fed is remaining very hawkish on raising rates, continuously raise rates to really curb inflation. That's their primary objective, and that's really causing a lot of volatility in the market, right? So you have these treasury yields that are volatile. Like right now it's starting to set a new standard, I think, but it's been moving in 30 basis point swings, on a day, 2-day basis, which is virtually unheard of. Even during the mortgage crisis, it never moved, or the housing crisis rather, it never moved this volatile. So, it's tough for these banks to get a grip on what's happening. And if it's tough on the banks, it's, the consumer obviously has no idea what the hell to do, just because, they don't want to buy a house at a 7.5% rate. So they don't really know what to do. Plus, inventory is still pretty tight out there. There's not a glut of inventory. So it's just an interesting dynamic that's taking shape, and it happens so quick. Is really what it is. Like, we're going
to talk about the speed at which things really morphed. Mm-hmm. But I want to, the thing that's the theme, I should say, now is fear, because there's fear of the consumers entering or buying or selling. But I mean, banks are laying off people. I mean, a lot, right? What are you seeing there?
Well, yes, there is a reduction in workforce throughout this industry across the country, and but a lot of it was ramped up to keep up with the volume that came in the last few years. So, refis, when refis get hot, I've been a part of 3 different cycles, and when it gets hot, you're talking, it could be a 7-8 to 1 ratio refi versus purchase. So these banks, they just get inundated, so they have to ramp up and over ramp up, and then refis, like anything, again, the third cycle, they just slow down to stop. So now you have all this staff and I can't say no loans coming in, but you have a in some cases an 80% reduction in volume, overall volume. So sure. Yeah, that's where these layoffs come in. It's unfortunate, and we are, it's still going on right now across the country. So,
well, I know that there's, like you said, I heard it was 70%, and these are some statistics, or these are the highest rates in 22 years. So if you talk about 22 years ago, home values were maybe half, maybe 2/3. So we have really this almost perfect storm, and I am hearing that there's much more inventory. So in my market, in New York and others around the country, you have this question: where were these sellers that decide to sell now? They sat on the sidelines and now look at the prospects of their home loan rate if they buy.
Yeah, these, right now, again, when I say earlier that there was a lot, inventory was light, it's by region, of course, right? So, some sellers just kept on the sidelines. They're not. They thought they can get more money for their home, so they stood on the sideline. Now, if they're thinking of selling, what are you going to buy? So if I sell, my house and I make a tremendous amount of money, what am I buying? So and with the rate being higher, it really, you're at a crossroad there, so like you really got to wanna, you know, you really got to you're going to spend more money per month, because, you're talking about a 6-7% rate in certain cases, depending on the product. And that's why you have some people just staying on the sidelines. And in terms of downgrading, that's a different story. You do have pockets of those going on, but when you downgrade, you still might wind up paying more, because homes are so much more money than they were. If you've owned your house for 15, 20 years and you're going to downgrade, what are you downgrading to? You're going to downgrade
to another state where really where it's different. There's this one graphic I saw yesterday, and Facebook is full of crazy memes, but one said something like, I don't know, let me find it. One said something, here we go. It says, if you pay 7% at 30,000 under list, whatever that means, is better than paying $100,000 over list at 2.99. I mean, is that math right? Paying 7% on a lower price, which really is not a lower price, it's what it probably should have been before. So paying 7% at an appropriate price is better than paying 3% on those crazy deals over ask, 100,000, 50,000. What do you think about that?
I think you can make any number work to your advantage. I mean, they're not wrong, but does that make it a bad thing? I mean, it goes back to what your motivation is to purchase a home. If you're looking to flip it, I get it. Yeah, then the math works. But if you're buying it because you love the school district and you want to raise your kids there and you love the community,
right. And that's to me, the investors and flippers are an outlier. That's not representing the market. But I actually think that meme is wrong, because you're I don't, we'll talk about this in a second. No, it's the monthly payment. So the $50,000 or even $100,000 would loan amount, wouldn't that be, wouldn't that rate not be so impactful? Wouldn't it, I should say, the payment not be so impactful? Isn't the large loan amounts still better at a lower rate?
Larger loan amounts are always better at lower rates, because you're borrowing, obviously, for, you're paying back less. I mean, it's just, you're paying the bank back less, rather. So yeah, that math is absolutely correct. Again, these memes, I'm not a meme guy. I don't really post memes at all. I think they're, you could spin a meme, although some of them are really funny.
They're funny. They're great. I love some of them. And I just wonder who, but I don't know how to make it, but some people come up with some really funny stuff. I mean, I admire that.
Oh, the creativity is just, it's amazing. When anything.
And maybe if they put that effort to some good use. But Jason, there's something I want to talk about that, and this alludes to two things, I think: education and trust. And I want to combine serving a client with working with your referral partners. And this is important, because you're in New York and your market is in New York. You're not lending money, to my knowledge, in Nevada or Arizona, correct?
We do, actually. We lend 38 states, not Hawaii, not Alaska. We don't do jumbo loans there. We don't do non-conforming loans there. We'll do we'll do conforming loans in those 48 states. We only do non-conforming or portfolio loans in a selected amount of states throughout the country.
Okay, when you say we, it means your bank, but I'm saying you and your referral partners, you're a New York-based guy, Long Island and City, I guess, and you're a New York guy with your own personal business.
Mm-hmm.
Okay, so and the reason why I asked that is because lawyers are involved in your deals versus Nevada. Right. So the deals that Jason is involved has a third level lawyer on each side.
Right.
Okay, so because of these rates, there's this program which I want you to talk, the 3-2-1 or the 2-1, which always existed with a seller's concession, or maybe please describe what that means. I'm going to throw some softballs at you, but I'm also going to try to poke some holes in this approach. And it's always been there like a sleeping giant, but now we really woke him up. So what are people doing with regard to these programs that you know of? And then we'll talk about the education, how they can be implemented.
So the 3-2-1 is pretty interesting because it's been around a while, and there's nothing overly special about it, in my opinion. You know, I've I've seen it done. I've never done one specifically. I sometimes just curb the customer, where I think in my opinion, it's better to just pay points and buy the rate down. It's kind of a temporary Band-Aid, So if you buy something first, and it's a 7% rate, 3, 2, 1, have 4%, and the following year you'll have 5%, then 6, and so on and so forth. So, and it's being basically subsidized through a seller's concession, which is pretty good. And we can get into that, how seller's concessions work. But that's really all it is. It's just that you're temporarily buying down the rate. I think it's no different than just going after an arm.
Okay, so somebody's buying down the rate, either the buyer or the seller, right? So that's that.
Correct.
And I've even heard banks kicking in the 1% to make that happen. So there's really 3 possibilities. Yeah. But the loan is underwritten at whatever today's prevailing rate is. So let's pretend it's 7.
Correct.
So you get this temporary relief, either 3 or 2 or 1 year. But then at the end, it's not an adjustable rate where it could run wild. It is what it is today. You're just postponing it.
Correct.
Okay. That's interesting. So it's not subject to the market in 24, 36 months. You know when you go to bed what is going to be today. Yeah,
it is the product work, the way the product works is it's in the name, 3, 2, 1.
Why? I mean, another Facebook meme because we know so many people in the industry is marry the house, date the rate. You're not dating the rate because you're stuck with the rate.
I've heard somebody say that too. It's cute. Again, it's a cute meme. You marry the house, you date the rate. Yes.
I think it's very lame for people on social media delivering, either a purposely deceptive or an incorrect message, because you're not dating it. If you don't want 7% today, why do you want 7% in 24, 36 months?
Exactly.
So you just want to break. You just want to break to buy furniture and paint the house.
I know these temp buy downs they're nice products. They're tools to push a home, to spurt buying. I get it. But again, there's other ways to do it that are less.
Yeah, I have a way that I wanted to share with you, but we'll get to me last. So,
right.
We said there's 3 ways. The most rare would be the bank kicking in. I've heard of 1% that some places do. But so we know the traditional means is a buyer pays discount points. Mm-hmm. And tell me how that works. What if they paid 3 points, which is, everyone says we don't want to pay points. That's like the whole mantra forever. So if you realize they're paying either way in the monthly payment. But let me ask you, well, how does it work? If they pay 3 points, 4 points, give me the metric. How much does that decrease the loan rate?
So it's not that easy to describe because it goes on a day-to-day basis based on the mortgage-backed securities and the treasury yield. So the price changes daily. So, but if you're going to pay 3 points, conventionally, 1 point buys you down about a 1/4 point to 37 bips in rate. So it's not 1 point, if you pay a
1-to-1 ratio, it's really 4-to-1.
Right. It's so, if I pay a point instead of a 7, I may wind up with a 6 3/4, or 5/8.
It would be reasonable for a realtor, because keep in mind, one thing I want to talk to, no matter what you do and whatever the client wants, there's a very important person in the middle, and that's the realtor. So that's where the education and the networking comes in. Right. That I want to talk to you about. But so ballpark, Susie, the agent somewhere could say 4 gets you 1. I mean, about
4 points.
4 points gets you about 1 if it's 2.25 each. It's like $1 gets you 4. 4 quarters gets you $1.
So if you're paying 7, if the current 0 point rate is 7, let's say, and you pay 4 points, you can probably get down to 6, maybe sub 6.
Okay, so that's fair. 4-to-1 ratio, ballpark. No.
But here's the thing though. Like, you're maxed out by how much you can technically pay. Some of these states don't allow it. There's high cost rules that kick in. So what you really have to do, and this is where the education to your point comes in, is you have to describe to the customer the payment at 6% and at 7% and weigh out that difference. Okay. And you do the math over 5 years. And if paying points, if you can make back your money inside of 5 years, then paying points works. Okay. Paying points.
You hit something that, finish that. I want to tell you what I see is an issue.
So paying points works sometimes and sometimes it doesn't. You really have to weigh out the economics, because if you take out a 30-year fix, conventional wisdom, I'm just going to base it on conventional wisdom. If you pay points and you can make back the savings, right? The savings difference between whatever rate, 0-point rate is, and where you pay points, wherever you land. If you can make back the difference inside of 5 years, then it was worth it. That's, to your point earlier, that 30,000-foot view. That's how CPAs would see it. If you can make it back inside of 5 years, then it's worth it. If you can't, then it's not worth it.
Right. But people may be short-sighted and say, I want to get in the house and ease into home ownership and have a lower payment, and I don't care about 5 years. I just want to have, more money to settle in my home and make it where I want it to be. They just may be, as I say, short-sighted, and I'll take my lumps later on. Maybe I'll be making more money. I get a raise. I get a second job. My wife will do better. My wife will enter the workforce. So we know that instead of X per month, if you get 500 or 700 more a month, that paints a lot of rooms and that changes a lot of windows.
I mean, a lot of that would be, if a good loan officer would actually profile the customer, have a conversation with them to
Right.
see what's important. You can determine in a conversation if that's important to them or not.
Yeah, I know, but it's up to the wants more than the needs at some point. These decisions, wallpaper are not based on, and furniture is not based on reason. It's I like
Right.
it. So even the toilets, and I know we went crazy with things, simply put, because we were young and wanted it and knew that we lived there. So, but let me give you an important point. You just said you speak to the customer, but unfortunately, tell me if you agree that the paradigm exists as I describe it. You don't talk to the customer. You don't talk to the customer. You talk to the customer after you've been referred by a realtor in a lot of cases, if not most, correct? So now they're good. I mean, and I'm not going to knock realtors, but we both know, one plays first base, one plays second base. You don't have that conversation in a vacuum, like a Wall Street trader might speak to someone about. There's a third party, and there's the third party that referred to you. So you only have that conversation when someone is really interested, or worse, has an offer that they still, to some extent, now the prices are coming down, they're going to be vying to accept their offer. So now, number one, you won the house, and the offer, let's talk New York here, the offer did not include the request for a seller's concession. This is why I'm very bearish on this approach, especially with New York, because there's another layer, and the most important layer, the lawyers, because you're not going to, it's really hard to go against a lawyer's advice when you don't know what you're talking about. Right. So let me just play this out. Jake, I'm the realtor, I refer you. You only get it if we make an offer without Jason at a kitchen table on a Saturday at 3:00. The listing agent gets back to me and says, okay, now I know the realtor language. You're messing up the deal. We have an offer for 400. My client, the seller, I'm the listing agent, never agreed to pay any closing costs, Sally. What are you talking about? My seller's still drunk on 2021 values. Who's Jason? He wants my seller to pay points. We've never paid points. We don't do that. So you're going to start educating at that point when it could be, in French, a fait accompli, a done deal. And then on top of that, the realtors are going via text when you're living your life, which they don't reach you, and others are not asking for what could be or will be deemed a price reduction. What if a seller went down, 4 or 5 price cuts, they get a buyer, and they hear they got to give more money up?
you know, as anything, I'm not trying to kill a deal for a realtor. You know, when I profile a customer, I just see I talk to them, finding out what's important to them. If I'm getting a deal from from an agent, usually they'll give me a heads up the direction of the deal, so I'll know where to take it. You know, I'm not going to rogue.
Um, Jace, you there?
Yep, I'm here. Sorry, I got a call. I had a call come in, so I just sent it. Yeah, I'm not going to take it in any other direction. I will do right by the agent,
There's
so
no question about that, but I'm saying, let's say there's nothing about you. The point I'm making is this is an endemic issue. This is lenders are second, and deals, and unless I'm wrong, you sometimes talk to a banker. I'm sorry, you sometimes talk to a buyer before there's an accepted offer, and you should, and people want that, but it really only becomes real upon an accepted offer, because now we really need financing. You give a pre-approval. So, but just for the record, I'm stating, I'm being recorded, I'm very bearish on this approach being used, because this could upset a lot of people, and that's where the education comes. So this is my important point. This is where lenders who really are B2B people work with agents have to really spend time, as you are in this video, and you have to educate agents before they make offers, demonstrate that it is not a scary thing, and you have to be, and I think I would love to, there's no protocol in place. There's no, the way you want to bake a chocolate cake, there's a way and a recipe, and you want to change oil in a car, program a computer. There is no standard way to explain this and gain an ally with agents. So that's, you could know everything, you could well serve the client, but A, the buyer doesn't know about it, and B, all the best laid plans go astray when the seller is caught unaware.
Yeah, I mean, as a lender, like I said, I'm never trying to kill any deals, and I'm always looking for the easiest route.
Of course. I'm talking about if it's snowing, it's outside our control. And then in New York, where you are, there's an issue which never comes up with realtors, and that is, my seller will pay, 3% seller's concession, which is allowable. I think up to 5 or 6 is allowable. FHA or conventional 5, 6, FHA, whatever.
You have to pay it. It can go the other way, by the way. So it can be if you're buying a house for $500,000, and you go into it needing a concession, and essentially you go, let's say it's, for argument's sake, 3%, okay? Then you go into contract at $515,000, and the seller gets their $500,000, and that $15,000 goes towards closing costs. The only caveat to that is that the property has to appraise for at least that.
That was my lawyer point,
right?
Because realtors can say yes to anything, but you know that your deals in New York are going to get a lawyer to and from. So the next question is, what if it doesn't appraise? You could put a provision. That means that the buyer doesn't get it.
The buyer doesn't get the concession. Yeah,
right.
I find that most realtors are more concerned with whether the buyer can, because let me take a step back. If a seller's concession is needed, and it's a deal breaker, if it doesn't happen, I think that's when most agents are more concerned. A seller's concession should be more of a luxury item, more of a way to help. It shouldn't be a deal breaker.
So Jason, there used to be a distinction between a seller's concession and a seller contribution. This is more of a seller's contribution.
Well, seller's contribution, I haven't done one of those in a while, because sellers weren't always amped to kick up, So,
in this case, we all think about this. So we've overcome every hurdle. Education, the buyer wants it. The buyer's agent can understand it and convey it, which is key, on their own without you via text message. That's big. They're going to convey this to a listing agent, never heard of it, and ask a seller who doesn't want to give up any money. And on top of that, if that all works, now lawyers are going to ask the natural question, what if it doesn't appraise? And then the answer would be, then you don't get it. Now, a buyer might be banking on it. And all this happens in the most informal of ways, texting, emails, maybe a phone call. And I think I'm not trying to knock it. I think we're all remiss in not acknowledging the circumstances. And
really, it was just a tool. A seller's concession, really just a tool in a rising market, in a bullish housing market. Yeah, it works because it allows homes to move. It allows people to save money, at least buyers rather. It allows them to save money, to do other things. And in a market that's flat to declining, no, it's not good, because there's a good chance the property might not appraise. Now, if I'm an agent and my buyer needs that concession, then what? Do I lose the deal because the house doesn't appraise, or it appraises for less than the concession? So there's a lot of variables there. So, that's.
You mentioned appraisal now, and I don't think appraisals are going to be a problem now, because they're reflective of what was sold, and whether we like it or not, those are the most compelling piece of data.
Right.
So we're still, the seller may be drunk on those prices, but the empirical data is going to show prices that closed, not really so what's being asked or what will happen. So today, I think you're not going to have that price, but I could see springtime, early summer.
Based on the current trend of this housing market for the year, it can happen. It can happen quick. All of a sudden, it's just doesn't appraise, and then now the appraiser's crazy, or the bank is crazy. So now that you try and find another lender, or because
right. Well,
people think that appraisers work for banks. They don't. They're contracted by banks. So
of course, but I don't think it's going to happen quick, because the appraisers are stuck with recent solds.
Right.
But when you have this next cycle of these houses in the market today selling at a lower price, we're really talking about, in my mind, like March, April, reflecting the January closings. That's where I think you're going to see the real movement down in appraised values.
Yeah, it's going to happen, and when it happens, it's going to happen quick. You'd like to see the market. These markets aren't stable right now. It's just all over the place. So that's why I say it's going to happen quick, maybe even quicker than spring, because it's just not a stable market. It's all over the place. And so what I mean by that is, if you're going to be at 7%, and the market knows, and I'm just picking 7% rate, by the way. It's been mid sixes, low sevens for.
And they're coming down. They're coming down, aren't they? There's a trend recently come down.
Actually, that trend just completely reversed. You have a 4.21 10-year Treasury yield, and we had 3.95 just last week. As you can see, it's a 30 basis point swing. It's been pretty consistent on a 30 basis point swing. Plus you have the Fed unloading. They're through quantitative easing, they're unloading the debt also. So you do have a lot of pressure on these yields. But for the market to continue, in my opinion anyway, for the market to just continue and start getting back on track, you need stabilization. If you're going to be 7%. Let the market adjust, let people adjust, and it'll sell. Homes will sell. But when you're 7 today, 6.5 last week, 7.5 next week, people don't know what the hell's going on. So that's when you get a lot of these standbys. People are just on standby. This is what I see. You have a lot of people just on standby, wait and see what happens with rates. If you're going to be 7, be 7. Stay there, but that's why I think it's going to happen quicker than spring, and it'll stabilize. Once these markets stabilize, once inflation starts coming down and the Fed goes more dovish instead of hawkish, and everybody's like, okay, this is the direction now, but you still have crazy data out there. And a strong consumer, no less, which is crazy. And if you saw the unemployment numbers today, the 3.7%, it's still, it's historically low. So,
but Jason, I've always had, from a long time, I've always had believe it or not, you may never have heard this before. I've always had a problem with calling real estate a housing market. I never call it that. I don't even believe it's the right term, because look at other markets that are based in fact. Securities companies exist and they buy and sell daily. There's not 100 down to zero. They don't go out of business. So look at energy market. There's 1,000 homes in a city. They're always going to need energy. It's not like 500 or go away. They don't. So those are constant buyers, and we know those are defined as markets. How can we consider a group of consumers, such as buyers, that either look at the millennial shift that's coming or we're in? So it's a massive, massive all-time buying potential craze, or one we're supposedly in, that really, really has changed the scope of the consumer. And then also look at how now buyers are on the sidelines. So how could we compare buyers at 7% with buyers at 3%? And on top of that, this is my last point, if you use energy today, you're going to use it forever. But once you buy, you're not buying any more houses. So it's really, I've never accepted that that's a misnomer, a buyer's market. People come and go and increase or decrease. How's that a market?
Well, if you're labeling it buyer's market, then that by definition is a buyer's market. When I say housing market, housing market consists of buyers, sellers, Home Depot, Lowe's, contractors, everything. That, in my opinion, is the housing market. When you have, that's everything.
But that's the housing market. That's the housing market today. I mean, in energy, they don't say this is the energy market today. It's constant. Our consumers in real estate are not constant. That's a very easy distinction to make. The energy people are not going to say, I don't need energy this winter. Well, people can stay, and even if the prices quadruple in energy, you got to pay it. So that's my point. It's just a side. I mean, that's why I think some of these comparisons are not valid, because what you tell me, you tell your viewers, how much are the loan applications decreased as of right now?
Well, loan applications, I mean, if you go just year over year, we're down north of 80%. North of 80% year over year.
That's crazy.
Yeah. But what was crazy too was the influx of mortgage applications. We were at ridiculous levels of mortgage applications, so much so that the entire industry had to ramp up to a point where now there's massive layoffs. And you're talking about you want to talk like 12 to 18 months swing. That's exactly what happened. So yeah, it was crazy when it came in. It's the reduction is crazy too, but it always overshoots on both directions. The volume coming in was unsustainable, and this 80% reduction, it'll balance out. It will balance out. That I know, because that's what happens. It will balance out, because there's opportunity is going to start coming about, and people are going to start seeing that. And to your point earlier about the millennials, they are the largest generation that are going to come in to this new wave and start purchasing.